You're listening to the Learn Like a CPA podcast, where we talk about all things real estate, tax strategy, and personal finance. Whether you're a real estate investor looking to scale your portfolio, or you're an individual wanting to take your financial freedom journey to the next level, this is a podcast for you. Hey everyone, today we're going to be talking about the different types of investing vehicles that you can use to build wealth. These are specifically going to be tailored around retirement accounts, but we're also going to talk about something called the taxable brokerage account. So there's three main types of investing accounts. Now, what's important to understand is that these three accounts, you can all invest in the same thing. Stocks, you could do stocks, you could do ETFs, mutual funds, whatever it is you want to do inside of that account. It's just the way that the account is taxed could potentially be different. So the three main breakdowns, the categories are going to be, number one is going to be your traditional 401k or IRA plan. This is going to be what your company is most likely going to offer to you. If it's just called a 401k plan, odds are it's a traditional plan. But let's break down what it means to be a traditional plan. So traditional retirement plan is something that you receive a tax deduction for when you contribute the money. So you're getting a tax deduction for the amount that you contribute. So if I was to contribute $1,000 and let's say I'm in a 20% tax bracket, I would get a $200 deduction, 20% times $1,000 towards my taxable income that year. So it's a way to invest money in a retirement account to grow and earn, but also get a tax deduction up front. The caveat is that money inside of that traditional account, whether it's an IRA or a 401k, it must stay in the account until you're 59 and a half, unless you want to pay a penalty. If you withdraw 401k or IRA money before the 59 and a half year mark, age limit, then you will be paying the 10% penalty. It's important to note that traditional retirement accounts, they come out as ordinary income. So when you do pull the money out when you become of retirement age, it's ordinary income and it's taxed at your marginal tax bracket. And this gets important a little bit later on. So the traditional accounts, IRA or 401k, you're going to get a tax deduction up front. It's going to earn and grow tax deferred. However, when you withdraw the money, you're going to be paying taxes when you go to withdraw. Now, the key thing here is when we're utilizing traditional retirement accounts, we're banking on one huge factor. The idea that we're in a higher tax bracket now than we will be at retirement age. And this makes sense for most people. You know, you might be making a lot of money in your career, but once you wind down and go to retire, maybe you're making less money, right? Because you're not working. So the idea there is we want to get tax deductions in years where we're making a lot of money, therefore our tax rate's higher, so the deduction that we're going to get is worth more. Right? So if I'm in a 30% tax bracket, I'm getting deductions at 30. And then when I retire, maybe I'm only in a 12 or a 22% tax bracket, that I won the game, right? I got tax deductions at 30%. And when I went to go pull that money out, I'm only paying 12%. So from a tax strategy perspective, I won the game. So those are the traditional retirement accounts, traditional IRA, 401k. It's also important to note that on a traditional IRA, if you make a good amount of money, as I believe single, it's $65,000, $70,000 a year, and married, it's double. You no longer get a deduction for contributing. If you make over a certain dollar amount, I could post the amounts in the show notes. If you make over a certain amount of money, you no longer get the deduction. So it is worth noting that. Again, the name of the game with the traditional retirement accounts is we're going to bank that we're in a higher tax bracket when we're investing the money, and we're going to be in a lower tax bracket at retirement age. Switching over to the Roth style of investing, whether it's a Roth IRA or a Roth 401k, we do not get a tax deduction when we deposit the money or when we make the contribution. However, that money is going to grow tax-free, and when we're 59 and a half and when we go to withdraw the money, it's going to come out tax-free, which means that ordinary income tax that we would have had to pay on the traditional account, the Roth account doesn't have that. So you might contribute $80,000, $90,000, $100,000 into a Roth account over the course of your career, and that money may grow to, say, $1 million. And when you withdraw that money, it's all tax-free to you. You're not paying a cent on that money. And that's important when we talk about this strategy that I'm going to bring up in a little bit here. So Roth IRA, Roth 401k, you do not get a deduction when you put them when you contribute the money. However, it's going to earn and grow tax-free, and when you ultimately withdraw it, you're not going to have to pay taxes. To dive a little bit further, there's the Roth IRA. The Roth IRA is a little bit different. It kind of stands out between the other types of retirement accounts because with the Roth IRA account, it's something that you control yourself, that you open yourself. You're not going to open it through your employer, but you're able to open it up yourself, and you're able to contribute to a Roth IRA if you have earned income. Okay, you own the account. You get to pick the investments and the fees, and this is also an important part too. What I've noticed when I was at an employer, the fees and the expenses inside of a 401k plan are much, much higher than a IRA account. The IRA account is going to have less administrative fees, less expense cost than your 401k plan. So most of the time, it's cheaper to invest inside of an IRA than it is a 401k plan. Also, if it's in a 401k plan, you have to focus on the rules that the company is giving you within inside of that plan. Whereas an IRA, you can really determine what you want to do with that money and when you want to control that money. You can always access contributions to a Roth IRA tax and penalty free. So if I contribute $10,000 to an account and it earns and grows to $20,000, I can always pull out that contribution amount tax and penalty free regardless of my age. And so the Roth IRA sometimes serves as an emergency piggy bank in a sense that if my savings account is dwindling or going down in value, right? It's a fire sale and I need to access money, I can always tap into my Roth IRA account tax and penalty free. Can't do that with a 401k account. Cannot do that with a 401k. Another thing with the Roth IRA is you can receive up to $10,000 of earnings from that account tax-free as long as it's for a qualified use. So some of the qualified uses are first-time home buyers, education expenses, medical expenses or disability, first time having a child, adoption sometimes. You can withdraw money, earnings from this account, the Roth IRA account, tax-free, up to $10,000 of earnings if you meet one of these exceptions. One thing to point out with the Roth IRA account, though, is that if your income is over a certain limit, and I believe for single people, that's about $125,000 a year. So if you make more than $125,000 a year, you cannot contribute to a Roth IRA anymore. You have to play this backdoor shuffle game, and it's something we're not going to talk about in today's episode, but just understand that if you make a certain amount of money, you can no longer contribute to the Roth IRA. The third style of investing account is what's known as a taxable brokerage account. So this one kind of is the unicorn of the retirement accounts, I believe, because it's technically not a retirement account. There's no sort of tax savings on the front end, no tax savings on the back end. This account, you are putting in after-tax dollars. So you're going to receive your paycheck, that money is going to get taxed, and then you're going to contribute it to this account. And while you're earning and growing inside of this account, again, with a taxable brokerage account, you can pick the stocks, you can pick the mutual funds, you can decide which companies you want to invest in with this account. However, as it's growing and earning, you're going to get statements, and they're 1099-B statements for interest, dividends. You're going to have distributions inside of that mutual fund maybe. You're going to get taxable events throughout the way. Although very small on a year-to-year basis, you are going to get tax forms for that, and you're going to have to report that on your tax return. Whereas a retirement account, an IRA, or a 401k, you're only getting a statement if you were to withdraw that money. Versus a taxable brokerage account, you have to deal with that every single year. However, the key point with taxable brokerage accounts is that the interest and dividends that you receive from that account are typically taxed at ordinary income rates as the stock or the mutual fund's earning and growing. However, the nest egg, the amount that's equity that's growing over time, if that mutual fund or that stock has been held for at least a year, it's considered a long-term capital gain. And what's awesome to understand is that long-term capital gains are taxed favorably compared to short-term capital gains or regular ordinary income, because long-term capital gains are taxed at 0%, 15%, and 20% depending upon income levels. And the way that this works is I look at how much I have in income, I look at how much I have in capital gains, and that determines what I'm paying in taxes on the capital gain. Now, if you are married, under current law, if you're married and you have no other income besides capital gains, you can withdraw up to $106,700 completely tax-free if they're long-term capital gains. Let's say I withdraw maybe $200,000 from my taxable brokerage account. $100,000 is contributions, $200,000 total, $100,000 is gain. I can take that completely tax-free. So as long as it's a long-term capital gain and I don't have any other income. So it creates this almost a way out of working if you want to invest in retirement accounts as well as a taxable brokerage account. This is for somebody who says, hey, I don't want to invest in real estate. I don't want to own businesses. I don't want to be an entrepreneur. I want to work a W-2. I want to hold down the fort. I want to spend time with my family, and I want to retire early. This strategy is for you. It's going to combine taxable brokerage accounts with retirement accounts, okay? So you're going to contribute to your retirement accounts, preferably a Roth account, whether it's a Roth 401k or a Roth IRA. Also hammer out your taxable brokerage account, because I cannot retire before 59 and a half if all I'm doing is traditional retirement accounts or regular retirement accounts. However, I can retire at 40, 45, 50 if I have enough money in my taxable brokerage account, and I can retire completely tax-free. Again, how does that work? Well, if I make $106,700 in long-term capital gains, I don't have to pay any income tax on that amount due to the favorable long-term capital gain tax treatment. So if you combine Roth accounts with taxable brokerage accounts, you can easily retire at an earlier age, not have to worry about the 10% penalty, not having to worry about retiring before you're able to from the retirement account perspective. You're able to withdraw that money, pay 0% in taxes, and build and grow your wealth, right? So the strategy, again, we want to invest in our retirement accounts, Roth accounts, traditional accounts. We want to hammer out our taxable brokerage account. Now, something to keep in mind, though, is if your money is in traditional retirement accounts, so we said traditional, you get a deduction when you put the money in, but you're going to pay taxes when you pull the money out. What happens in a traditional brokerage, traditional retirement account, an IRA or a 401k, is that income, when you go to withdraw that money at 59 and a half, it gets stacked on top of your other income, of your ordinary income. And so what that does for your capital gains is it could potentially make a tax on your capital gain, on your long-term capital gains. So that's why a more favorable strategy is to hammer out your Roth IRA or your Roth 401k and invest in taxable brokerage accounts, because when you pull distributions from those Roth accounts at 59 and a half, that does not increase your taxable income amount, which means you can still pull the same amount of money out of your taxable brokerage account per year, tax-free. Again, this year it's $106,700, but I would assume in 20 to 30 years, this number is going to be much different because of inflation. You can have that same strategy, and when you do turn 59 and a half and it's time to tap into that retirement account money, it's not going to change that situation. So I can retire at 40, 45, 50. That bridge between whatever that age is and 59 and a half, when I can pull out of retirement accounts, that bridge is settled, that bridge is complete by the taxable brokerage account. And that's why I love a combination of all different types of retirement accounts. We like traditional accounts, we like Roth accounts, and we like taxable brokerage accounts. It's all a part of your wealth building strategy and your journey. So again, this strategy using the taxable brokerage account to invest money in, it does have its downsides. One of the downsides to me is anytime you see a stock ticker or you see a mutual fund losing value or it's in the red, you're more inclined to sell it in a taxable brokerage account than you are in a retirement account. I believe the government puts the 10% penalty on the retirement accounts as a way to dissuade people from pulling money out of the account, because they know that they're going to get hit with a penalty. The taxable brokerage account doesn't have that. So if at any point in time I see that the sticker price of a stock is going down and I want to sell, I can sell it. And there's not going to be any penalty for me to sell early. And they know this. Needless to say, it's very important to understand that with a taxable brokerage account, you also have to have that discipline necessary not to want to take out any money out of that account on a day-to-day basis. Learn to use it as a long-term wealth building tool, get those long-term capital gains, and it can be an awesome, awesome way to invest tax-free. Thanks for tuning in to today's episode. If you have any comments, feel free to leave them below. or you can reach out to me on Instagram and Twitter at LearnLikeACPA. I'll see you guys in the next episode.